Hello, everyone. Good morning. Welcome to day four of the revision, AFM revision. For those of you who are new, I am Paritosh Panchal. We have already done 3 days of revision. The first day we went through certain exam tips and tricks. Wait, just a moment. Yeah, that's right. On the first day, we went through certain tips and tricks, exam tips. On day two, we did I think we did advanced investment appraisal, and in day three, we did advanced risk management, wherein we discussed some bit of theory and solved two section B questions. But from the past experience, we were not able to complete the two questions properly on time. So today, I have selected only two questions, no theory. So we'll be doing one question is of restructuring and the other question is of revaluation, right? So let's begin. Question number one is Hanwood Shoes. Hanwood Shoes, wait a minute. Yeah. Hanwood Shoes Company started trading. Okay, before we read the question, we shall read through the requirements. So calculate the expected sale price of children's shoes division and demonstrate its impact on Hanwood Shoes' statement of financial position and forecasted earnings per share. Okay, uh, the light is flickering. All right. Um, so here we are selling some shoe division, so we need to find out the value at which we are going to sell it and what impact will it have on the earnings. So part of restructuring probably as selling off a division. Discuss whether Hanwood Shoes Company investors are likely to be satisfied with the proposed sale of children's shoes division and its consequences for profits and funding. So 7 marks of that, where we have to discuss whether the investors would be happy about it or not, and its impact on the profits and funding, which we are going to calculate over here, the forecasted EPS. Right? Professional marks, 5 marks for analysis, evaluation, skepticism, and commercial acumen. Now let's read the question so that we have some purpose now. Hanwood Shoes Company started trading 40 years ago, so a pretty old company, manufacturing and selling children's shoes in shops. The shoes have been of higher quality than shoes produced by its competitors, although also more expensive. So it's on the premium end. School shoe sales is particularly have been consistent, large generator of cash, helping to fund the company's expansion. About 15 years ago, Hanwood Shoes started manufacturing and selling adult shoes. Hanwood Shoes, so now we can see that it's manufacturing students as well as adults. Hanwood Shoes, adult shoes are currently sold at a higher profit margin than the children's shoes. The adult shoes sales now generate majority of the Hanwood Shoes company's profits, and the adult shoes sold are a mixture of formal type and with a long lifespan and some fashionable shoes. The inventory turnover period for adult shoe is on average significantly higher than the children's shoes. So inventory turnover, that means the churn is much higher for adult shoes. So we can say that more sales is happening of adult shoes, most probably, unless they are maintaining less margin, which we need to check. But anyways, when we read, we'll get to understand that further. But what we do understand from this paragraph is that the adult shoe division is more profitable for them. Okay. And now contributes to a great profit. Like out of the total profits, majority of the profits are being generated by Hanwood. Hanwood Shoes Company is organized on basis of two separate divisions for children's and adult shoes, so two separate divisions altogether. Its shops sell either children's shoes or adult shoes, but not both. Hanwood Shoes Company also sells adult shoes to other retailers. 5 years ago, Hanwood Shoes Company restructured its cost base. It moved production of children's shoes to new facilities in its home country and outsourced the production of adult shoes to foreign supplier. However, Hanwood Shoes Company now predicts that the profits from children's shoes will increase at a slower rate than adult shoes. It expects that in the next few years, a greater share of children's shoes market will be taken by companies with a lower cost base. So we have outsourced the adult shoes business, but the children's shoes business is still manufactured in-house, as in the home country, and therefore has a higher cost most probably. And we are predicting that the sales will be a little slower. Okay, um, or the profits will increase at a slower rate for children's shoes. Hanwood Company Board is aware that it must convince the investors that any major strategic change it makes will result in an increase in EPS. Sorry. Investors will also consider a change in earnings per share against any change in business's profile of the company. So, um, whatever they do, they need to ensure that the EPS is maintained with the view of the keeping in mind the business risk profile also. Now, there is a proposal of sale of children's shoes division. So, Hanwood Shoes Company Board wishes to improve the company's cash flow for two reasons. First, loan notes of 175 million nominal value are due to be redeemed in just over a year's time. So, they want cash, right? Why? Majorly because one loan is maturing, $175 million worth of loan is maturing with after a year. The board is unwilling to seek renewed loan funding, so they do not want to take another loan to repay the old loan because the terms would not be favorable, and some investors have expressed concerns about the gearing levels as well. Secondly, Hanwood Shoes Company has recently been slow to pay some of its suppliers of adult shoes. One major supplier recently delayed delivery of shoes to Hanwood Shoes Company until it paid for previous deliveries. Okay, so there is some cash related issue. Probably that is why they are not able to pay their suppliers on time, and this has actually impacted the supply chain due to a certain delay caused by one of the suppliers of adult shoes, which is the more profit-making company. Um, and with all this cash crunch, they also need to arrange for a payment of $175 million next year, and they are not willing to take another loan because the debt to equity level is already high. Hanwood Shoes Company's chief executive produced that the company should in future only sell adult shoes and should sell the children's shoes division. He believed from industry contacts that at least three children clothing manufacturers looking to expand their product range would be interested. The finance director suggested that the proceeds from the sale of the division would be first used to pay off the loan notes of 175 million. It would then be used to increase cash held and thus improve liquidity. The remaining proceeds would be invested in adult shoes division to improve EPS. Um, so impact and consequence of sale. So the chief executive has proposed selling off the children's shoe division any which ways the profits are going to slow down. The growth in profits are expected to slow down. And he has also found buyers for that, okay, or likely buyers who may be interested. So the impact or consequence of sale is are rather the sales price of the children's shoe division will be the sum of the present value of the predicted future cash flows. The discount rate to be used is 10%. So present value, this is the general valuation model wherein or discounted cash flow, wherein the present value is nothing but um, discounting all the future cash flows. All right. So discounting will be at 10%. The predicted after-tax cash flows for children shoe division for the next 4 months, 4 years are given. The predicted after-tax profit of children's shoe division in year one can be assumed to be 76 million. The total after-tax profits for Hanwood shoes for year one, if the children's shoe division is not sold, is predicted to be $217 million. Okay. So all this is only for children's shoes. Now they have mentioned over here that year one children's shoe division is 76 million. It corroborates with what information is given over here. But if you look at the total after tax profits, that is, if the children's shoe division is not sold, it will be 217 million. Okay, this is including 76 million. So if you sell off the children's shoe division, it will drop from 217 to 217 minus 76. After year 4, free cash flows for the children's shoe division would be assumed to increase at a rate of 3.5% per year. So from year 4 onwards, it is just a constant growth rate. So this is, you could call this like your terminal growth rate. Okay, for children's shoe division is 3.5% per year. The proceeds received for selling the children's shoes division would be used firstly to pay the 9% loan notes. Part of the remaining amount from the sale proceeds will be held as part of current assets, so that the current ratio is 1.4. So current assets should be 1.4 times that of the current liabilities. The rest of the sale proceeds will be invested in non-current assets. So with the money that you get from the children's shoes division, just a moment. Yeah. From the money that you get from the children's shoes division, you will utilize majority of it, or your first priority is to pay that $175 million loan. Once you pay that off, then you try to improve your liquidity position by investing in current assets such that your current asset is 1.4 times that of current liability. Then whatever is left is invested into non-current assets, into expansion of the adult shoe division. The profit on the sale of children's shoes division should be taken directly to reserves. The non-current assets of the children's shoes division can be assumed to be 608 million, and the current assets can be assumed to be $349 million. So both of these values will get reduced from your balance sheet, because once you sell the children's shoe division, both of these will get reduced, 608 and 349. Additional investment in non-current assets is expected to earn an 18% pre-tax return, and an additional investment in current asset is expected to earn 6% per pre-tax return. So we are going to invest in non-current asset as well as current assets being 1.4 times current liabilities, and non-current asset, well, we don't know the exact amount or a ratio, but whatever is left, we are going to invest. So that investment is going to yield 18%. Okay. Tax is payable 20% on profits. Nothing about in arrears or anything is mentioned, so we shall assume that it's paid in the same year. Hanwood Shoes current statement of financial position. So we have the current balance sheet available to us. Okay. So what we can do is we can just copy paste the entire balance sheet and then work with that. Before that, let's first answer proceeds from selling of the children's shoes division, because that's what they have asked us first, that calculate the expected sale price, and then we have to demonstrate the impact on the earnings. Okay. Earnings as well as the financial position. So first, let's figure out the sale price. So you have all the after tax cash flows, right? And then they are saying that it will constantly grow at 3.5% per annum. So it is growing like that till infinity. So this 91, and then from 91 another 3.5%, another 3.5%, so on and so forth. It's still forever and ever and ever. So what we can do is we can first explicitly find the value of the one which we have forecasted, that is the first 4 years. So you find the present value. In fact, you could just do is equal to NPV. The discount rate is 10%. comma, select all the cash flows from year 1, 1, 2, 3, 4. So the implied period, the valuation will be $260 million. And then from terminal growth, that is from year 5 onwards, you are assuming a 3.5% growth rate. So from year 5 onwards, you will just do a perpetuity discounting. That is the cash flow into 1 divided by R. Now, since there is growth, so you will do 1 divided by R minus G, right? So this is present value as on year 4. Now, understand this, you need to do double discounting. This is like a delayed perpetuity, right? So the perpetuity does not begin from year 0, it begins from year 5. So you are discounting it from year 5 onwards. So basically, it's present value as of year 4. You need to further discount it with the 4th year discounting factor, and you arrive at $957 million. Okay, this is million. So the total present value of the children's shoes division or the expected sales proceeds will be the summation of the implied valuation as well as the terminal value, that is 260, or implicit plus terminal. Okay, so 260 million plus $957 million is equal to 1,217 million. So actually, this question had a bit of both. It had valuation as well. Okay. So very simple valuation because all the cash flows were given. The only tricky bit was this part and double, what do you say? So I'll just highlight this, or I'll make this bold. It's as on year 4. Okay. And then let me just put discounting factor 10%, 4th year. Sorry. Okay. I think this is a better way so that you would understand. Right. So $957 million, and this is how we find the total value. Okay. So just keep this in mind. We need to double discount it. All right. I'm just highlighting this so that you do not forget this step. In exam, you could do it directly also. Now, the impact on the sale on the statement of financial position, that is the balance sheet. So we know that we are expecting $1,217 million worth of an inflow. Okay. So the profit that we are going to earn out of it is, see, we are selling it for 1,217, right? And when we sell, obviously our assets and non-current assets are also going out. That is, our fixed assets are, how much did they give? 608 and 349. So this 608 and 349 is coming from here because we are selling off the non-current and current assets. Okay, when we sell off the division. So the profit that we earn is 260, or you could say from the asset side, 608 goes out, 349 goes out of the balance sheet. Okay, and inflows come in at 1,217. So net inflow will be $260 million. Now, out of this $260 million, we first pay the loans off. Okay, $175 million loan is paid out, so that's an outflow. Then we say that new current assets need to be purchased. Now, how much current asset will you purchase? We want 140% or 1.4 times of current liability. So what is our current liability? if you see, our current liability is 894. Now, current liability, no information is given about change in current liability. So, current liability would remain the same, and 894 into 1.4. Okay. So, see, 1.4 into 894 will be your targeted new current assets. Okay, that should 1252 should be the total current assets. So, where is our current assets? Here, right? So, it should be 1252 after the sale. Now, in order to make it 1252, how much more should we add to it? So, if you see, previously it was 909, right? Or I would say current or original, or I would say pre-sale. Okay, the pre-sale current SOFP. So it was 909. Then we are selling the children's division, in which we end up selling 349 worth of current assets. And we need 1252 to be after the sale. That means the additional we have to purchase is 909 minus this minus 349. Okay, or you could also write it as, let me put it on the side, an alternative calculation. You know that this is how we started. Okay, or rather you could write it this way. We need it to be 1252, but from there we already have 909. But from this 909, we are selling off 349. Okay, now since this is already in a negative way, so 692 million. Okay, that's why I'm putting plus. The only reason I'm making it a plus over here is because I've already written it negative over here. Sale. Or you could just calculate this over here as well, in the form that we need this much minus. Okay, so this is how you could write that 692. And sorry, you could find your outflow, that is increase in additional current asset, that what you are investing in the current assets, 692. Right? I hope this is clear. Now the balance will be fully invested in non-current assets. So how do we know the balance? The profits are, the inflow is 1,217, out of which you are paying 175, and then you are paying current assets 692, or not paying, but investing in current assets 692, and the balance left 350 is what you invest. Okay, so you get this 350 from here. Right? And this is nothing but the summation of these three. Okay. So we know our non-current asset, we know our current asset, so we can find the total assets. From share capital point of view, no changes are happening. From share reserves, all the profit will go into your reserves. So this is the profit, goes directly into the reserves. So reserves increase to 997. Okay, just because of sale. Right? So we arrive at total equity. Non-current liabilities, due to the sale part, we are settling a $175 million loan, the 9% loan notes, we are paying it off fully. The other liabilities remain as is. Same goes for current liability. You add all the equity and current liability apps, just check whether it tallies. Yes, it does, 2194. Okay. Now moving on to forecasted earnings. So predicted post-tax profits So current forecast and revised forecast. Revised will be after sales, current will be before sales. Just a moment. Let me see if I'm covering. Okay, I'm just covering the forecasted. It's just a word forecasted, so I guess it's okay if I cover it. Or wait a minute. Let me just merge it. Right? Yeah, works. Okay. So we finished two things asked. Number one, we found out the value. Number two, we saw the impact on the balance sheet. Now we need to find the impact on, okay, now we need to find the impact on the earnings, right? So predicted tax profits, we begin with 217. That is what is given to us, that the entire division would make 217. Okay, this is the information where we got it from, 217. Now we are going to sell off the children shoe division. That means 76 million will get reduced from it. Okay, so you are doing less reduction of children division, that is 76 million. Then you say that since sale is done, you are paying off a loan, right? So since you pay off the loan, you need not pay the interest on that loan. So you are saying interest saved due to repayment of 9% loan notes. Okay, and this is post tax, after tax. So you are saying that on the a loan of 175, you had to pay 9% interest, but it used to give us a tax benefit also, 1 minus t. So we are including that. And we say this much money, which previously used to go out, is no longer going out. Okay, so it is like saved. Interest is saved. So that's like an inflow. So this is in. That's why we are adding it. Moreover, we are buying non-current assets and they are to generate 18% returns. But again, on that return, we have to pay taxes. So we are doing 1 minus t. Then similarly, for current assets, we are generating 6% returns. So whatever our current asset is, additional current asset, that is generating an additional 6% for us. Again, post-tax, so 1 minus t. One thing to keep in mind, the returns are on additional only, because within this 217 already factors the old non-current asset and old current assets. Okay, so we need not put the 18% on the total non-current asset. Only and only, if you see this, it is only on the additional component, right? So just keep that in mind. That's another place where you could go wrong. So after adding all of these, we find out that after the sale, the profit goes up to $237 million. The number of shares is 50. How did we get it? We already know that the share capital is $50 million and we assume that the face value is $1. Okay, so there are 50 million shares. As we said, that there is no change in the number of shares, so that will remain the same. Therefore, total earnings divided by number of share will give you your EPS. So you find out your EPS grows to 4.75, which is nothing but a 9.3% growth in EPS. Okay, clear? Very simplistic calculations to be done. Due to a small restructuring, there was a problem that they identified and they decided to sell off a division and restructure the loan and improve their financial position. Okay, so this was a bit of restructuring as well as valuation. Now they are asking, discuss whether the Hanwood company's investors are likely to be satisfied with the proposed sale of children's shoes division and its consequence for profits and funding. So if you look at the profit, It seems to improve, right? It is doing well. This is all provided that um, you are able to generate additional returns at these expected rates, right? Now, beyond that, they have asked us to look at the funding position also. So funding position, we can find the debt to equity level. So probably could find it here. So debt to equity. Oh, sorry. Debt to equity. Okay. Now this is not a dollar. So previously debt was 0.5 or 50% was, or no, debt was 0.5 times equity. It has reduced, so that is good. Um, our reserves have improved, that is good. Loan has come down, right? So the funding level seems to have improved, right? So let's just go through the theory part. Investors may query the need for the sale this time, although the board expects the children's shoes market to become more competitive in a few years' time. This has not yet happened. See, this is where you are being a skeptic, saying that it is just estimated that the children's shoe division or market is going to become more competitive, and it is expected that the profits would slow down or the growth in profits would slow down. But has it happened yet? No. Okay, investors may wonder if a better sale price could be obtained in a few years' time with a few more years of growth. Although some investors are concerned about gearing, a sale to reduce debt funding may seem to be forced sale, and investors may ask whether alternative strategies could resolve the problem. Investors may also wonder why Hanwood Shoes is not exploring the possibility of selling off the production facility if sale proceeds equaled net book value would be enough to pay off 9% loan note. So when we sell off the non-current liability, we are getting a $608 million worth of inflow, which will easily pay off that $175 million worth of loan. Okay, so sell off, like how we are now contract manufacturing the adult shoe division. Similarly, we can even contract manufacture. Why can't we contract manufacture the children shoe division also? Right? So so we are just exploring different options, right? It's a holistic way. We have a balanced judgment. We have to view the whole thing from every angle, right? So angle number one, the reason they quoted for selling off the children's shoes division was a slowdown, and the other reason they quoted, or in fact three reasons they quoted. Reason number one was slowdown and intensive competition. That was reason number one for children's shoes. Reason number two was that they need to repay a loan and there is a a liquidity based issue. Okay, actually two major reasons, right? So we address reason number one, that it has not happened yet. And we are also talking about reason number two, that um, how about we kind of like outsource the children's shoes? It was liquidity. So if that's the only concern, then we can sell off the assets, pay off the loan, improve the liquidity, and at the same time retain the business by outsourcing the manufacturing. So we'll do the selling part. Investors may also wonder why Hanwood Shoes is not exploring the possibility of selling the production facility. If sale proceeds equals net book value, that would be enough to pay off the 9% loan note. And Hanwood Shoes could use the same outsourcing business model for producing children's shoes that it does for adult shoes. Okay. Investors may also be concerned whether Hanwood Company Shoes is achieving best value for the sale if the company is going to be selling the division at $1.2 billion. Okay, this is always a concern because everybody wants more, right? How do we know that? Because it is just the present value of future cash flows, right? What if there is since it's such an old company, there would be some goodwill associated with it. Why not add a premium to this price? Assuming a higher growth rate, perhaps by taking a geometric average of growth over the next 4 years, would give a higher selling price, and could also be expected to ask a premium on the sale, given that the number of companies looking to develop their sales of children's shoes may be interested. Having said that, the cash flow in the calculations are taken to infinity, which is optimistic. Okay, so you are also saying that yes, see, though we haven't added a premium, but we are assuming that the cash flows will grow at a constant rate till infinity. Okay, and which is kind of optimistic because maybe if the shoe business is actually showing a slowing down for children's division, then it may not necessarily grow at 3.5K, and maybe that company would have to shut down also. We can't say for sure. Okay. Investors would also wonder the decreased diversification that the sale would mean. Although adult shoes achieve higher margins than children's shoes, they may need more investment to maintain their position, and to appeal to the fashionable range may be uncertain. Children's school shoes have been a reliable cash generator. Ultimately, also the investors may feel that they are investing in a smaller company, given the decrease in non-current asset base and the range of products, and may want to invest elsewhere in the company offering better growth prospects. Okay, then we comment on the profits. That is the forecasted increase in EPS is 9.2%, but the investors will question whether the assumptions on which the forecast is based are optimistic or not. You are being a skeptic and you are questioning that. They will also take into account the risk of the business being less diversified as it will solely be selling adult shoes. However, part of the increase in profits is a fall in the commitment to pay interest, which investors may view positively if they are concerned about gearing, that is financial risk. So, financial risk is reducing. But at the same time, due to less diversification, business risk is slightly going up. Funding the sale will help fund an improvement in the gearing of the company. The funds will not be able to pay off the 9%. Sorry, the funds will not only be able to pay off the 9% loan note immediately, but they could also be used to pay off bank loans and other loan notes in time, or reduce trade payables as they may be they may be being used as a source of short-term funding. However, investors might also wonder how future investment in adult shoes shop would be funded, particularly if future sales did not meet current expectations. Current lenders may have placed restrictions on Hanwood Company seeking new borrowing from other sources. So if Hanwood Company was able to seek additional loan capital, it would have a smaller non-current asset base to offer as security, which may affect the lender's attitude. So this is on funding. Okay, now let's take a quick 5 to 10 minutes break, and then we shall continue with our next question, the last question rather. Okay, a quick break. All right, welcome back. Let's begin. Just a moment. Yeah. So the next question is Karen Company. A new client has approached you for, okay, before we read the question, let's look at the requirements. You're required to, is it, yeah, wait, yeah. Discuss possible sources of financial synergy arising from Karen Company's acquisition of Danton Company. Now, keep in mind that they are talking about financial synergy in specific, right? If you see here, possible source of financial synergy. See, there are more than one types of synergy, right? There is financial synergy, there is cost synergy, there is revenue synergy. You're not supposed to talk about all of them, just financial synergy. That is why in day one, I kept saying that it is important to read the question properly and understand and answer what is being asked. Okay. Just don't take the word synergy and start writing about all sort of synergies possible. Here they're explicitly asking you for a very specific type of synergy, that is financial synergy. So we'll write only about financial synergy. Okay, next, advise the directors on the suitability on a suitable share for share exchange offer which meets the criteria specified by Danton Company shareholders and calculate the effect of the cash and share for share offers on the post acquisition wealth of both Karen and Danton Company shareholder. So I think in the question it's a cash deal, but they are also asking us to suggest a suitable share for share exchange offer as well. Okay. And then compare the two. Discuss the likely reaction of Karen Company and Danton Company shareholders to the cash and share for share offers. So, what offer who would take? Okay, from both parties' point of view. Right, and then there's 5 marks of professional, so you could kind of say that B and C is kind of related with each other. Anyway, so now we can read the question. A new client has has approached you for advice on a potential acquisition. Karen Company is a consumer electronic manufacturer and retailer. The company obtained a listing 8 years ago, with the founders retaining a 20% stake in the business. So it's a listed company. 20% is owned by the promoter, and the balance 80% most likely is owned by institutions, well diversified. While Karen Company had previously experienced rapid growth in EPT, uh, that is its earnings before taxes, problems arose soon after the listing as competition intensified. Although the company remains profitable, annual growth rate has declined significantly and is currently 3%. Previously, the company was doing great, but post listing, due to whatever reasons, they have listed competition, intense competition has resulted in a slowdown in the growth. Okay. The board is concerned about the lack of future growth opportunities. So, see, if the growth slows down, your PE multiples would also slow down. So, your valuation would kind of come down because reduced growth. The board is concerned by the lack of future growth opportunities, which it should be. The current share price reflects these concerns, trading well below the offer price of 8 years ago. All right. So the price has, whatever institutions have had subscribed to our IPO, they are not making any money. Forget making money. They are kind of losing money because the current prices are below the IPO prices. In response, the directors, wait, just a moment. Yeah. Is it better now? Okay. No, just a moment. What happened? Just a moment. Okay. Yeah. All right. Sorry about that. A new client. Okay, we read that. So yeah, 3% growth. They are in concern. In response, the directors has decided to invest in a market development strategy for future growth, utilizing significant cash reserves to acquire companies in other areas of the country where competition is less intense. The board has identified a potential target, Danton Company. So they have thought of inorganic expansion, and they are planning to purchase another company which is situated in another area, another market within the same country, though. And the competition in that particular state may be less intense. Now, a little about Danton Company. So, Danton Company is a privately owned consumer electronic company. So, it's the same industry. Again, it's not new. It's 10-year-old company, but it is privately owned. So, it is not listed, right? Significant unrelieved losses were incurred in early years of the development, although the company is now profitable and achieving growth in earnings before tax of 6% per year. So that is double. It's growing at the double the rate of our current growth. However, cash reserves are low. Access to capital has acted as a severe constraint on Danton Company's reinvestment potential through this period. The founder and the families own 60% of the shares, with the balance held by a venture capitalist, which acquired its equity stake around 6 years ago. So VC entered 6 years ago, has 40% stake. The balance is owned by the promoters. VCs would be looking for an exit because it's already been 6 years for them. And the company is growing at 6%. However, it could grow more, but it is being constrained because they are not able to raise capital. Okay. And their cash reserves are also low. And there is significant unrelieved losses. So they are carry forwarding their losses, it seems. Okay, so they are profitable now, but initially they incurred a huge loss, which they are able to carry forward, right? So this loss, probably after acquisition, we can carry forward and set it off against our profit and earn some tax benefit. Okay. Um, Acquisition information. Karen Company's board is keen to ensure that Danton Company's. Okay, sorry. Is it proper? My head was getting. Okay, this is the area I can come to. Anyways, Karen Company's board is keen to ensure that Danton Company's founders remain as the director after acquisition, and the company has sufficient cash reserves to purchase Danton Company outright. Early discussions between the directors of both companies suggest, okay, so Karen wants to purchase Danton, but also ensure that the board of Danton remains intact. So basically, just purchase the entire company, but have the founders to still remain within the company and the board. Okay. And they plan on giving a cash deal. Now, early discussion between the directors of both companies suggests that Danton Company shareholders would approve a cash offer of $13.1 per share. So, if we are to give cash after negotiation, they have agreed on $13.1 per share. As an alternative, the board is considering a share for share exchange to fund the acquisition in order to preserve cash for future acquisitions and dividend payments. Because see, if you do a cash deal, a lot of cash goes out of Karen Company, and they won't have enough cash for maybe dividend payments. They won't have enough cash for maybe any future acquisition, because they are now going to get on a spree of acquiring and funding growth through inorganic means, right? Um, so the board has suggested, can we do a share for share deal? Now, a share for share deal will only be accepted if you are able to give a valuation that the $13.1 cash is able to give. Okay. If either that much or a little more, but not less than that. Okay. Recent mergers have, or maybe a little less than that, can also be justified by saying that you could be a part of the profits, but not a lot less though. Ideally 13.1 or more. Recent mergers have attracted an acquisition premium of around 25 to 30%, and Danton Company directors indicated their shareholders would be expecting a premium towards the higher end of this scale for a share for share exchange. So if it is going to be a share for share exchange, they are looking at an acquisition premium of a near 30%. Okay, not on the 25 side, but 30%. So um, as they said, towards the higher end of the scale. Okay, so 28, 29, 30, around that range. Okay, wait a minute. I'm not able to. Wait, let me just zoom out. Okay. Indicating that shareholders would be expecting a premium towards the higher end of the scale for a share for share offer. Karen Company has therefore asked you to design a share for share offer scheme which will allow a 30% acquisition premium. You have been provided with the extracts from the latest financials for both. I think it's both companies. Wait, yeah, both companies. Okay. Right. So extracts from the most recent financial statements, operating profits are given, and EBT is given. From your EBT, if you since you have your earnings, you can find like using if you have PE multiples, then you can just put the PE multiples on the earnings and get a rough valuation of the companies. This is before acquisition. Okay. Additional financial information: the book value of Karen Company's point 0.5 ordinary shares is $375 million. So this is the book value. The face value is point 0.5. So if you want to find out the number of shares, you can do 375 million divided by point 0.5. That will give you the number of shares of Karen Company. These shares are currently trading at $5.28 per share, and the finance director expects the price to earning ratio to increase by 0% if the acquisition proceeds. Okay, so there is no increase in the PE multiple. We are not expecting any increase of the PE multiple even after acquisition, at least for now. Danton Company upgrades its main manufacturing facility during the previous year and expects to make annual pre-tax cost saving of $2.5 million from the start of the current financial year. The book value of Danton Company's 0.25 million, sorry, 0.25 cent ordinary share is $35 million. So $35 million divided by 0.25 will give you the number of Danton Company shares. Also, make a note that the company is saving something due to a change in its manufacturing facility. The savings is to the tune of 2.5 million. So your earnings may increase by that much. Based on the analysis of the companies of comparable size and cost structure, it is estimated that Danton Company's PE ratio is 20% higher than that of Karen Company's current PE ratio. Karen's chief executive officer estimates annual pre-tax revenue and cost synergies of $15.2 million to arise as a result of the acquisition. Now, keep in mind, these are pre-tax, okay? So pre-tax synergy is 15.2. This is revenue plus cost synergies. In addition, the finance director anticipates an annual pre-tax financial synergy of $5.3 million. Okay, so total synergies would be the summation of two, that's 20.2 million. Again, this is pre-tax. The corporate tax rate is 20%. All right, so all the information that we need is given. We first have to find the value before acquisition. So we have earnings. We can just put the PE multiple. The PE multiple of Karen is already given. Sorry, it's not given. So we can, but we have the price already. So we have the price, we have the earnings. We can find the PE multiple of Karen. Using that PE multiple, they have said that Danton has a 20% higher PE multiple. So using Karen's PE, we can predict or we can estimate a Danton's PE. Using that PE multiple on the EPS, or sorry, on the total earnings, we can find the total value of Danton also. Okay, so we can find the value of both companies individually before acquisition, right? And then we have a scheme. There is either a cash deal or there is a share for share that we have to structure, which includes a 30% premium to the valuation. Okay, so first let's begin with the valuation. So Karen Company's number of shares, if you see 375 million dollars divided by 0.5, so we know there are 750 million shares in Karen Company. And what is the market value of those shares? So 750 million into the market price per share will give us the market capitalization, or the MCAP of, or the market value of Karen Company. So that's $5.28 a share. So we find out that Karen Company is worth $3.9 billion. Okay, so this you could also call it as MCAP, market cap. Okay. Future maintainable earnings. So if you look at the earnings, we have been given the earnings over here, 381.9. In fact, it would be a good idea to cell reference it. Wait. These are pre-tax. So this is earnings before tax, but taxes are payable. So 1 minus 2. Okay. And we arrive at 306. Sure. Yeah. $306 million is the earnings, post-tax earnings. Just write this, post-tax. Okay. So PE ratio would be price. We have 3960. We have earnings. Sorry, we have we have our earnings 306. So P by E is equal to PE ratio. That is 13 times is your PE multiple, right? For Danton, we know that this 116 is coming out from your 116.3 plus 2.5 is what they have told us over here, 2.5 million. If you see this, okay, 2.5 million is the savings that it's expecting due to that manufacturing facility. So that gets further added into 1 minus T. Okay, so don't forget, like in a hurry, you would just read the question. That is why writing a financial summary is going to help you out. Each time you read a number in the question, just write it down before you begin your solution, right? So Danton Company's PE ratio will be 20% over and above the PE multiple of Karen Company. So that's 15.6 times. We have the earnings. So earnings into the PE multiple will give you the Danton Company's valuation. Okay, so we could call this also MCAP, right? So now we have value of both the two companies individually. And if we have to combine both the companies, that is before the acquisition, it is worth 3960 plus 1478. However, there is synergies to it. Okay. So post valuation, including the synergies. So before acquisition, these were the individual values, which we just took it from here above calculations. All right. Now, we are saying that we are giving a premium of 30%. Okay. For the share deal, we need to give a premium, right? 30% premium. So we are giving that 30% premium over here. Now the excess that we have to the balance which is attributable to Karen Company, okay, would be this much. So how do we get this? We are saying that the company, wait, 43, just a moment. So we are saying that both the companies are worth 5438. Okay. Just a moment. If you see our synergy benefits, wait, we'll just write total synergy. Okay. Total synergies are where did it go? Synergy. That's why I like writing the financial summary here. 15.2 plus 5.3 million. Okay, 20.5. Now from this, we shall do 1 minus t, because they're pre-tax, right? Yeah, pre-tax financial synergies and pre-tax revenue and cost synergy. 15.2 into 5.3. Just a moment. I'll just be back. I just Yeah, sorry about that. I just realized that the answer wasn't complete, so I was just completing that, right? Um, so what we missed out was the pre-acquisition valuation that includes, sorry, post-acquisition valuation. So we found the combined company's valuation before acquisition, and now we are finding out that after acquisition, what is the value of the company. So combined company's earnings. So we have $306 million of Karen. Then we have $95 million of Danton. And then there is a revenue synergy of cost and revenue synergy of, wait, somewhere the earnings we have written increases by 20.5. Uh, where did it go? Just read it. Yeah. So it is this pre-tax. So you can write it as this. Okay, because you are going to save this much, right? So that kind of gets added to your earnings, total earnings. Okay, so 420 is what it becomes. Wait, yeah. A minute. So it's 20.5 only, 15.2 plus 5.3. Put it in a bracket. Yeah, it remains now. Okay, so that's how we got our combined earnings, right? Then we have our combined PE ratio. So we know that we are going to take the PE ratio of Karen, and then it grows by 10%. Okay, so 1.1 or 1 plus R. Okay. So we have a PE ratio, then we are doing a combined post-merger valuation based on PE. So PE multiple into your earnings is 5945. So what is the synergy that we are overall total synergy? I'll call it or total synergies created or value created due to synergies is the difference between the two. Okay, so this can be made bold, and then this we could highlight it. Again, remember all of these are in million. Okay, so this is the value that we are creating, and this 507, so ignore this 524. Okay, it is 507, that is the actual synergy being created. All right. And out of that, 443 is the premium given to Danton, right? 30% premium that we have to give to Danton. So that premium we are giving to Danton. So what out of the synergy is left for shareholders of Karen to enjoy is 63. So after valuation, if you see that these two companies are combining 4023 and 1922. Okay, they're individual. So if you just add the pre-acquisition valuation, then the excess that they are getting, and this is what the valuation is. And on a relative basis, so if you want to say that Danton is 1, then Karen is 2.1 times of Danton. Okay, or just relative valuation. So total value is nothing but the summation, which is nothing but 5,945, which we just calculated. Karen company's new share issue. So if you are saying that it is 2.1 times So we have to issue 750 divided by 2.1, right? So new issues that we have to issue and give to Danton Company would be 348, 358. Okay, how many shares of Danton already exist? We calculated over here. Where is it? Number of existing Danton shares. Where did it go? Okay, we didn't calculate it over here, but it's there in the question. We had the 35 million divided by 0.25. Okay, why is it 140? Wait. Yeah, this is how we get our 140 million shares of Danton. Now, to these 140 million shareholders, we are to issue 358 million shares. That means a ratio of 2.56. Okay, so if you have to say a ratio of 2.56, right, then you are kind of like giving 7 shares, and so rather for every 7 shares you are issuing eight. Sorry, for every 18 shares. No, wait. Yeah, sorry. For every 7 shares, you are issuing something almost like 18 shares. Okay, if you want it, write it in whole numbers. So the way you approach it is you do 1. So 1 doesn't work because 2.6 is not possible. 2, 3, 4, 5, 6, 7. So the 7 is the closest, like it's 17.9. So almost 18. Okay, so that therefore we are sticking with 7. Again, it's not accurate, or you could just leave it at this. That share for share offer would be for every 1 share, you will issue 2.56 new shares. Okay, so for every 140 million shares, 358 million shares will get issued, right? So Danton Company shareholders will receive 358 million new Karen Company shares. So total Karen Company shares after uh, this share for share deal will become 358 new issued plus 750 which were already in issue, right? So total number of Karen shares becomes 1,108 million shares, or 1.1 billion shares have been issued. So if you look at the ownership stake, Karen Company shareholders own 67% of the company, whereas the balance is owned by Denton Company. If you look at it from a valuation point of view and see how the growth is happening, well, before acquisition, whatever we have taken from above, okay, the original valuations before acquisition. Now, Danton Company shareholders would, if you are talking about cash proposal, so they were getting 13.1 million, $13.01 new cash for every shareholder, so 140. And Karen Company post acquisition, well, the total company after acquisition is worth 5,945. From that, you are reducing 1,834. So 411 is what Karen is worth. So increase in shareholders' wealth if it was a cash deal. This is cash deal. Okay. And this is share for share deal. Okay. Am I covering it? Wait. No, right? Okay. Seems fine. So this is your cash deal. It is growing up by 3.8%, and Danton Company's shareholders' wealth is going up by 24%. If you do a share for share deal, then Karen Company is, or you could just say 67% of the total company. Okay, instead of doing this whole thing alternatively, you could just say if Karen Company is 67% of this whole thing, and here you will say this is 32.3%. Okay, was just that of the entire company. So if it was a share for share deal, then in that case, these were their this would be the growth for what the shareholders are going to witness. So that's a 30% growth that which as per the brief given to us that they need a 30% increase is being met. So the terms of the share for share offer meets the criteria specified by Danton Company shareholder. Okay, clear? So see, very quickly, I'll just revise through because there was a small blip. Firstly, we are finding the pre-acquisition valuation with the information given to us. So before acquisition, individually, we are finding out. And then if we just combine the two without any synergy benefits, 5.4 billion dollars was the combined valuation. Now, if you see the combined earnings, so now we are trying to value the company based on PE, the combined value of the company based on PE. So individual earnings plus the synergies, okay, one minus tax for the synergy. To that, we are adding, we are valuing on based of PE multiples. So after based on PE multiples, the valuation post merger will become, or post acquisition, you could say. Post acquisition valuation is $5.9 billion. So the difference, that is the synergy being created, is $507 million. So out of 507, 443 is given as premium because we are considering a 30% premium that Danton Company wants. Okay, so the balance 63 million is enjoyed by Karen Company. So post-tax valuation, post-acquisition valuation individually is this much. On a relative basis, we find the ratio. And based on that relative ratio, we shall issue new shares. Okay, new shares have been issued. In fact, this is not required, but okay, I think I've self-referenced it to this, so I'm keeping it here because we have already written it over here, 5945. Okay, this is nothing. Let me just put it over here. Another, the same thing. Okay. So yeah, based on the ratio, we are issuing new shares, and then we are getting for every existing share how many new shares are to be issued. So that's 2.56, and based on that, what is the ownership and what is the growth? Okay. So with this, and since it briefs meets the brief, so we are done properly. And obviously it has to meet because we are giving a 30% premium over here. So that's why it's not by coincidence the brief is being met. It is by on purpose that we are making the brief meet. Okay. So that's how it is done. Yeah. So that's it. Then you can just go through the theory parts of financial synergies that we are enjoying. Many acquisitions are justified. Again, we first write about synergies in general, wherein many acquisitions are justified on the basis that combined organizations will be more profitable or grow at a faster rate than the companies operating independently. The expectation is that the acquisition will generate a higher than expected cash flows or a lower cost of capital, creating value for shareholders. The additional value created is known as synergy, the source of which can be categorized in three types: revenue, cost, and financial synergy. So a little bit about what synergies are all about. Now, based on the scenario, there are a number of possible sources of financial synergies. As a private company, Danton Company is experiencing a funding constraint wherein parent company. So you are talking from a funding or a financial point of view. Okay, Danton is experiencing a funding constraint, whereas Karen has significant cash reserve but limited growth opportunities. The combination of the two can create additional value since Danton Company may be able to utilize Karen Company's cash resources to fund its expansion in a way which would not have been possible otherwise. Leading to, because we know that Danton was not able to access capital, which Karen already has. So with that access to capital, it can grow further. Assuming both companies' cash flows are less than perfectly correlated, those of the combined company will be less volatile than the individual companies operating independently. The reduction in volatility enables combined company to borrow more cheaply also, and possibly cheaper financing than otherwise would have been possible. This increase in debt capacity and therefore the present value of tax shield increases the value of the combined company in form of lower cost of capitals. In fact, we see also financial synergies being uh, in place. So, anyways, you can read through all these. There is no point of me reading through these. Okay, so you can pause and read. Now, moving on, cash for cash offer. So, very briefly, we can just discuss it. You can see for cash, Karen company shareholders will prefer it because their value increases a little more, but Danton company may not necessarily agree. However, in the question, it's given that Danton will be okay with that sort of cash deal. Okay. In fact, that $13.1 is from the question. Where is it? After negotiation, they had agreed to it. Where did it go? Uh, remember reading it. Yeah, over here. Okay, you see this over here, $13.1 per share. Okay, so that's how the whole funding is, uh, as in they have agreed upon 13.1. Okay, so from a cash offer point of view, the main advantage of cash offer is that it provides Danton Company shareholders with a certain and immediate return. However, the premium is lower as compared to a share for share offer and may be reduced even further if the realized gain gives rise to a tax liability. By indicating that, so obviously when they receive money, they have to pay capital gain taxes also. By indicating their preferred premium under both offers, it is possible that the shareholders have priced in the risk associated with uncertain share for share offer. Okay, because see, if you do a share for share deal, there is no certainty whether the acquisition or whether the combined company will actually realize all the synergies that they are predicting. Okay, so possibly that's why they have been demanding for a more premium when it's a share for share. So on this basis, they may be indifferent between the two. So cash offer may give rise to agency issues since Danton Company's founders no longer have a stake in the business, even though Karen Company board is keen to ensure that the founders remain in the position after the acquisition. The information provided is too limited to read too much into the intention of the VC. However, typically a VC would expect an exit within 3 to 5 years. In this case, they may prefer a certainty of the cash offer. So this is where commercial acumen comes into play, wherein you are saying that typically any which ways VC would like an exit after 3 to 5 years. So they may not be too keen being tied into shares. Okay, they may prefer a cash offer. But having said that, even if they get their shares, they can always sell it in the market later on. The cash offer transfers more of the added value to Karen Company without the need for dilution, which may appeal to their shareholders. As indicated in the question, Karen Company's existing reserves are sufficient to fund the cash offer, although this may constrain future dividends and or investment decisions. And if you go for share offer, both set of shareholders benefit from increased wealth as a result of share offer. though marginally so in case of parent company shareholders. So parent company shareholders are just increasing their wealth by 1.6%. So it's very marginal. Another drawback is that parent company shareholders percentage are also diluted under this method. However, a share for share offer, because they no longer own 100% of the company, they own only 67%. However, a share for share offer would ensure that Danton Company's founder interests are aligned with parent company shareholders, because they want the founders to be still in the company, and the founders will have some stake in the merged entity. Okay, so there won't be an agency cost. They are kind of the owners, reducing the possible agency costs. It also provides Danton Company shareholders with the right to participate in the future growth of the larger company, which the cash offer would prevent. So, no basis have been provided for the synergic benefit. The increase in shareholders' wealth is so marginal, even a minor deviation from the estimates would result in a reduction in shareholders' wealth for the owners of parent company. On this basis, it is quite likely that they will not approve the share for share offer without any further negotiation around the acquisition premium. Because see, the acquisition premium is around 25 to 30%. We have assumed a higher end because we are asked to assume the higher end of 30% premium. But with a 30% premium, we are gaining only 1.6. We, as in Karen Company shareholders, just gaining 1.6%. Okay. Now, in real, we know that synergy benefits do not materialize as per expectations. Now, on what basis are the synergic benefits conservative or aggressive? We don't know. There is no information available. So we would say that 1.6% move, like a small drop in synergic benefit, would result in no shareholders' wealth appreciation for Karen, and therefore they may not necessarily be interested. In fact, even this is, it doesn't really seem that great. 3.8% marginal increase. Okay. So with that, we are done for today. We'll meet tomorrow. Now, tomorrow, initially, I planned a mock, but looking at your feedback, firstly, I am happy that you all are getting value out of this, and you are benefiting from this. And I have taken your suggestion with regards to covering questions from section A as well. If we did a mock tomorrow, we would have ended up doing one question A, one question from section A, and two questions from section B. So rather, we'll do probably two questions from section A tomorrow. That's what I have planned, taking your feedback. Okay, so tomorrow won't necessarily be a mock per se. We will do two questions of section A, and we'll end our 5 days of revision that way. All right. Thank you all for your time. I hope you got to learn something today as well. All the very best for your exam. I'll see you tomorrow around the same time. So I'm Paritosh Panchal signing off. God bless you all.